You're listening to the Business Wealth Impact Podcast, your source for empowering information and cutting-edge ideas from the world's top minds. I'm your host, Jeanne Amlour, founder of seven-figure coaching company, Jeanne Amlour International. Join me on a journey to unleash your potential and create your highest success. Welcome to Business Wealth Impact. Hello, and welcome to another magnificent show, if I do say so myself. We have a great guest today. Walli Miller. Now, Walli is a financial coach for millennials, and she helps them achieve financial independence. Welcome, Walli.
Hi, thank you so much for having me. I'm super excited to have this conversation and to talk all things money and financial independence.
Completely love that. Okay, now, first of all, you talk about something that is the theme of work optional. I think let's start there so people just start understanding, they start to understand what your philosophy is. So what is work optional?
Yeah, so it is exactly the way it sounds, which is when you have the option to work or not to work because you have reached financial independence. When we're thinking about what financial independence means, it simply means that you have enough that it covers not only your basic living expenses, but all of your lifestyle expenses. And so that number is going to vary for each person. Someone living in New York City might have a little bit higher of a financial independence number. Someone living in rural Kentucky might have a lower financial independence number. But at its core, financial independence simply means you have enough to either retire early or to make working optional.
Okay, fantastic. How do people get that work optional number?
Oh, yes. Okay. So I am a little bit of a money nerd, and I always have been. And I will say that for most of my late teens, early 20s, even mid 20s, I thought I was pretty good with money. I knew that people said, stay out of debt, don't get into debt, debt is bad. And so because I didn't have credit card debt, I was like, okay, I must be doing this money thing right. And under certain terms, I really didn't. I used credit cards, but I made sure to pay the balance in full. But I was missing a piece, right? I knew to save a portion of my income. So I set some money aside. I didn't even know what I was saving for, but I just heard stay out of debt, save some money. But I was missing the wealth building component. And it wasn't really until my early 30s where I sort of read this very clickbaity article. And it was about a couple who had to retire in their 30s to travel the world. And as I read more into their story, I realized that something they kept talking about was building wealth in order to reach financial independence. And that saving money wasn't the way to get there. The way to get there was through investing. And that was sort of what piqued my interest. And I realized that, yes, in some ways I was good with money, but I was missing a really huge piece. And it was that wealth building piece.
For sure. Now, thank you for bringing this up, because if you save money, there is a very finite number that you are going to save in a lifetime, right? And this is why we need to invest, obviously. And I don't think being in your early 30s is that old, because I learned about this stuff when I was way older than that. So don't feel bad about that. You're never too late. Okay, so you understood. At least you were not in bad credit card debt. Okay, and being in some sort of debt is not always bad if it's a mortgage on a house that you can afford the mortgage, right?
Mhm.
Although sometimes that's another whole story. Sometimes you're better
Right.
off. Sometimes you're better off not buying a place. Okay, but that gets very involved.
Yeah.
So you can save a certain amount, but you're not multiplying. It's not exponential and it's not compounding, right? Okay. So when you realized, oh, I get it, I actually have to invest, what happened then?
And I just to stick on the debt piece, right? Sometimes debt is sort of categorized as good debt or bad debt. I don't even really like using that term. I think debt is either cheap or expensive. It's either
Mm,
productive or unproductive. And so when we're thinking about what we're using the debt for, using debt to buy something we cannot afford, like, an expensive vacation or a handbag that's going to sit on a shelf is one thing. But using debt in a productive way, where it's less expensive to own, but it is appreciating in value, something like a real estate property or something like that. It's totally different story, because I think sometimes debt as a whole gets this bad connotation. And I for me, I stayed out of credit card debt because I knew credit card debt had higher interest, but I did have student loans and I also had a car note, right? So later on, I ended up buying my first property at the age of 28. So I did use debt, but in my mind, that was productive debt. I was using that debt in order to buy assets that could help me, right? So I spent
Mm.
money on an education and on college. I used college debt. And although I didn't know it at the time, but it was a really good investment for me because I had a really good network of people. I was able to expand my knowledge of things in the world and things like that. Now, again, not all debt is productive. There's some people who take on these more, huge mortgage size college loan debts and unfortunately isn't as productive. But I really sort of like to, when we're thinking about taking on debt, just think about how is this what is this producing? How is this adding value to sort of my spreadsheet, right? Sure,
Mm.
things can add value to our lives and to our lifestyle. And that's also important, but let's also take a look at the numbers. So I just wanted to make like that caveat because I'm not anti-debt, but there's expensive debt and there's cheap debt, and then there's productive debt, and there's sort of the inverse of that, right?
Okay, I love how you broke that down, so I couldn't agree more. People are black and white about this. The fact is, you are correct. Some people going to university, that is productive because the loan is not so bad, they won't be crippled for their life.
Mhm.
And they could have gone to another university and gotten the same amount of value and gotten the same level of job from coming out of it. So they didn't do the real analysis. And that's hard for young people too. They just want to go to a certain university. Okay. Now, I agree with you. I call it a cheap loan.
Mm.
Some credit card debt and some debt for me is a cheap loan. Like I would go into credit card debt and I would move it to 0%. So I never paid any interest at all. Therefore, there was almost no fee and I was using other people's money really.
Yeah.
Okay. Now, let's talk about investment. I agree. If you invest in getting help like a coach or somebody that's going to help you, the investment also is good debt if they help you, because then you will be making money from it. So it's also an investment. And that has to be all weighed. So great. But you just said you bought a piece of property in your 20s, though. Was that your house to live in, and it wasn't an investment vehicle?
So in the beginning, it was just my primary residence. So we can sort of
Ah,
talk about, whether or not your primary residence is an investment. It was just my primary residence. But
hmm,
even at the time, I was 27. I purchased that home not really understanding the true financial ramifications of that. And I think a lot of people are the same way. I just saw other people in my age group who, went to college, got a good job, and sort of like the next thing seemed to have a family and to buy a home. And that was something that I did. And, one of the ways that I turned my primary residence into something that was somewhat of a great asset for me at the time, right? Because of course it appreciates over time. But it was I just ended up having roommates, so I could
mm,
afford the mortgage on my own. But I ended up having one roommate and then two, and thankfully it was a really great roommate situation. I love those ladies. We've been friends for years. Um, but at the time, there were two people that I didn't really know. I got them as referrals from someone else, and they started paying me rent. So it wasn't my intention. So I just purchased this home, and it was like a 2,300 square foot. I bought it for me and my dog, right? So this is what we're thinking about, the 27-year-old self of, mine. I made almost an accidental investment,
yes, yes.
but it ended up working out really well because it was within a few months. I had the first roommate and then I had the second roommate, and that worked out really well.
So they paid the mortgage. That's called house hacking now.
Exactly, exactly.
Right. So some people have been doing that forever. It's not like house hacking is new. Okay. So you did that just because that wasn't like, oh,
It
gee,
was
I'm
an
going to make this
accidental.
investment. It's an accident. Okay. Well, God bless you. So you did that. But then you started realizing, wait a minute, I've got to build some wealth. So talk about how and we'll talk about what you do, which is investing in the stock market, which a lot of people are not investing in the stock market. But I thought it'd be good to have you on because you're doing it in a very safe way that anybody can do. And the sooner they do it, the better. The younger you are, the better for this, right? So having said that, how old were you when you started your strategy?
So I again sort of made an accidental mistake, and which ended up being really beneficial to me. One of the things that I sort of realized was that I was already an investor. I just didn't know it yet.
Mm,
And one of the things that I realized was that putting money into something like a workplace retirement account, or if you're self employed, into a solo 401k or a SEP IRA, setting money aside for that could be an investment. And I say could be, and it should be. But one of the biggest mistakes that I made, and I see so many people make, is that they will begin to have money set aside into something like a workplace retirement account. They're like, okay, I need to set this money aside, let that grow. But they forget the second piece of investment. The first one is contribute to that account. The second piece is to actually choose the investments. And so, sort
mm,
of like a takeaway for anybody, whether you're working with a financial advisor, whether or not you set up something on your own because you're an entrepreneur, or if you're working a 9 to 5, make sure that not only is the money going into the account, but that the money is actually being invested. And I did not
mm,
know that second piece. So when I understood that putting money aside into a 401k was actually investing, I felt really happy because I said, oh, I've been doing that all of these years, right? I
mm,
started working at a job that had, we didn't have a 401k. I worked for the government. So we had a thrift savings plan, but it's
mhm,
very similar to a 403b or 401k. And so I knew that every paycheck, there was some money going into that account. But what I didn't realize that it was sitting in nothing more than sort of like a glorified savings account. It was in
right.
either settlement fund, or sometimes you'll see it marked as a money market account. And
Mhm,
so it was growing, but it was like growing very slowly. It really was nothing more than a glorified
mm,
savings account. And so then I realized, okay, I have to choose my investments. When people ask me, what should I invest in? I always ask them, are you setting money aside into a 401k? Are you setting money aside for retirement? And I think
mm,
for a lot of times when people think of retirement, they're like, yeah, but I don't want to wait until I'm 65 or 70 or even 60 to wait to retire. But the reason
mm,
why I like those type of accounts first is because we think about the biggest expenses in our lives, right? We think about food, whether that's groceries, eating out. We think about accommodations, right?
mhm,
Housing, utility expenses. We think about transportation, right? Vehicle
mm,
insurance, car loans. I always like to use this acronym of take a look at the fat. So, food, accommodation, transportations, and I add an extra T, which is taxes. Food,
mm,
accommodation, transportation, and taxes. And the reason why I like retirement accounts as sort of like the first place to sort of think about when we're thinking about beginning to invest is because of the tax benefits. And this is huge,
mhm,
particularly for those people who live in big cities and states where you're not only paying federal taxes, but you're also paying city taxes, you're paying state
mhm,
taxes. And if you look really at your paychecks, right, and you look at the amount of your tax return, and you look at the line of where it says like taxes, it is a huge expense that so many of us overlook. So I always
mm,
like to guide people to retirement accounts and set aside the word retirement, right? Because there are ways to access this money, even if you are 50, even if you are 45. But I like to
mhm,
begin there because of the tax benefits. So that is something when people will say, well, what should I invest in? The question that they're asking is like, what company should I buy? Or what stock
mm,
should I purchase? Or what index fund to buy? But really, it's like, let's think about before we get into the individual sort of investments, make sure you're taking advantage of some of the tax benefits. Like, literally in the US, the IRS incentivizes people who set money aside for retirement. And you can either reduce your tax liability now, so you can pay less
mhm.
taxes right now, or you can pay the taxes now and sort of set it aside and
Right,
don't have to
right.
pay
I'm
taxes
a
later
fan, I'm
on.
paying it later. Okay,
Yeah,
so
either one.
right. Okay, I love that. And the good news is if you have your own business, you can get a solo 401k
Yes.
set up. That's so people, and you can look into that because that's obviously I don't have a JOB, neither do you. And I'm guessing you set up a solo 401k as well with your business.
Yeah, the solo 401k, SEP IRAs, Roth IRAs, traditional IRAs, these are all vehicles that solopreneurs, entrepreneurs, small business owners can have, which can be really fantastic. So workplace retirement accounts are like the simplest, right? Because there's this entity sort of dealing with all the administrative
Yes.
stuff. But as a entrepreneur, there's so many accounts available to you. So I don't want anybody to think that, oh, I don't have a 9 to 5, or my employer doesn't offer a workplace retirement account, that I sort of miss out on that tax opportunity. And as you mentioned, something like a solo 401k, a SEP IRA, even just a Roth IRA or traditional IRA, depending on what your income is, you might qualify for. So it's definitely a place to look at. And when we think about what an IRA stands for, it's just individual retirement accounts. So we have those workplace retirement accounts or retirement accounts that are tied to our work, whether you're an entrepreneur or not. But there's other types of retirement account that you might also be qualified for, as long as you have some sort of income.
Right. Okay. Awesome. So that's the bedrock. That is no money left on the table. That's the first defense of don't lose money, right? To me, that's free money. Don't lose it. I love where you start, because first, before we start to make money, we got to see where we're losing money needlessly. So now close all the gaps and take advantage of that. Okay. Beyond that, then what did you do?
Yeah. So as I mentioned, the first thing you want to think about is like sort of like that container. So
For
those
sure.
type of accounts. And I like thinking about the retirement accounts. The next question is, once I have that account, what should I invest in? And a lot of people, when they think about investing in the stock market, they think about someone sitting in front of a screen with a whole bunch of red and green charts and lines, and that feels really overwhelming. And it is. But investing in the stock market does not have to be that way. Investing in the stock market could be simple. Okay. And one of the things that I like to invest in is, rather than thinking about what company is going to raise in value, right? Which company is going to 10x, 20x, 50x my money, right? Instead of sort of thinking about a specific company, because it's not about only knowing when to purchase, you also have to know when is a good time to sell. And so many of those things vary on things that are way out of our control. The economy, policies, change in board, right? In sort of the board of directors, change in leadership. So many, all of these things really are out of our control. And we would need to be on top of that all of the time. And a lot of people feel overwhelmed by that. Now, I will say, when I first heard about investing in the stock market, I thought it was nothing more than gambling. I said, I see people leave the casino crying, and I see people on Wall Street crying. Like, why would I want to gamble with my money? Why would I want to do that? But investing, especially for the long term, is very different than sort of like trading, right? Where you are constantly looking, reading reports, listening to analysis, being on financial calls. All of these things feel really overwhelming, and investing in the stock market doesn't have to be that way. So I mentioned a term earlier, which was index funds. So what is an index? An index is just a list. So if you've ever heard the S&P 500 index, the NASDAQ index, the Dow Jones index, these are just lists. And these lists all have different types of things. So if we think of the NASDAQ is not the entire stock market. It only has technology companies. When we think about the Dow Jones, it doesn't have the entire stock market. It only has legacy companies, right? There's about 30 or 40 companies inside of the Dow Jones, inside of this list, on this list. And these tend to be legacy companies, companies that are tried and true, that have been around for a long time. Okay. And then maybe you have heard of something called the S&P 500, Standard & Poor's 500. And if you've heard that, that just means it's the top largest 500 companies in the United States. So you're trying to think, what is the best? Well, think about the S&P 500, which has the top 500 companies in the US stock market. And right now, there's about, I think, between 3,800 to 4,000 companies in the stock market. For some people, they might be surprised to realize that it's that big, or other people might say, oh,
Mhm.
that's it, only 4,000 companies in the entire US stock market. So when we're thinking about a list or an index, the S&P 500 is not all of those companies. It's just taking the best. And so the
Mhm.
way that I like to invest is to think about, rather than trying to think about what is going to be the new up and coming business,
Mhm.
right? And then staying on top of it to make sure that it stays that way. I like to invest in an index fund. So I like to invest in one of the lists, and I prefer
Mhm.
something that's a little bit more diversified. So the NASDAQ is technology company. There's a lot of potential for growth there, but there's some risk there, because if the
Mm.
technology market gets hit, let's think of the 1990s, early 2000 tech bubble burst, right? Or there's
Mm.
even a list of only real estate companies, right? So, but imagine only be invested in an index that only follows real estate companies. Imagine what that would have looked like in 2008, 2009, 2010,
Mhm.
right? So I like the S&P 500 because not only does it have 500 companies, it has the top most the largest 500 companies. And also, if there's a company that starts to struggle and is not doing too well, guess what? It gets kicked off, and the next one in line gets put in. And I don't have to worry about managing that, right? It does it
Mm.
automatically. So I'm always invested in the top 500 companies. And so
Okay,
I'm
awesome.
I'm sort of what you would call an index fund investor.
Right. Okay. That by far was the best rundown I've ever heard anybody do of what the indexes mean. And I thank you for that because
Thank you.
you're welcome. I was just thinking, this is great. She's taking people through all, because we hear that and people hear that. Now they know what that means. That's power. So I really thank you for explaining to my listeners the basics, which are important. Okay. So you've got the S&P 500. So you invested in that fund. Now, I have a feeling that you vested in something else because you mentioned this before. You did a total stock market fund. Okay. Explain to people what that is.
Yeah, so the S&P 500 is the top 500, and the total stock market fund is, now you invest in the entire stock market, and you don't have to do 4,000 trades or 3,800 trades. You don't have to
Mhm.
buy 3,800 individual companies. You just buy the list. You just buy the
Mm.
total stock market index, which is the list of all of them. And what
Mhm.
you will see is that if you did a side by side comparison between the top 500 companies and the total stock market index, you would see that they are pretty much in line. There's a little subtle difference, but they're pretty much in line. And the reason for that is that the top 500 companies are so large. They take up so much market capitalization. So they have a lot of
Mhm.
weight, that whatever those top 500 companies are doing, they pull the smaller companies with them. And so the way I like
Mm.
to think about it is that if you and I are pulling a wagon, we have the strength of two adults pulling the wagon. So we are the S&P 500. Now imagine
Mhm.
on the other side, there's, maybe 20 or 30 little kids, elementary school students. They are also pulling the wagon, but because you and I have much more power, much more strength, we are bigger, we're going to pull that wagon further than what those smaller kids do. Now they're making progress, right? They're growing. Some of those companies can be really profitable, but they're just smaller, right? So when we think about small companies that are in the stock market, they can be really profitable as well, but they just don't pull as much weight. So if we think about some of the top companies, and forget about the top 500, if we think about the top 10, we're thinking about Amazon, we're thinking about Google, right?
Yeah,
We're thinking about
we call them
Apple.
blue chips.
Yes,
Blue chips.
exactly.
Yes.
Yeah, so
Mm.
those blue chip companies have a lot of weight. So whatever, if they go down, it tends to bring the entirety of the stock market down. But if they go up, it tends to bring the entirety of the stock market up.
Okay. So you have some slight diversification going on here, right? Because you got the S&P, but then you've got and there's going to be a little bit. The reason why you're investing in two is because there's a little bit of diversification, slightly. Okay. Now I'm fascinated by what you told me earlier. You said I was working, my husband was working, then we started doing this, and we were able to retire. Now that shocked me because I don't see the numbers being that high in investing in these very safe investments. So give us the numbers of what you put in and how long it took you to be actually getting dividends on this. How did that work? Were you getting dividends from these? I don't know if those funds actually pay a dividend,
Yes,
but
they
how
do.
did you do all? They do. Okay. How did all this work as far as the numbers? I was very curious to hear how that panned out.
Okay, so as I mentioned, financial independence, early retirement or retirement is not an age, it's just a number. You think about
Mm,
how much you need in order to cover all of your expenses. And once you've hit that number, you can retire early, you can retire, or you can become work optional, which is essentially what I did. And so it was in my 30s when I sort of understood okay, I need to begin building wealth through the stock market. And I started with my employer's plan. And
hmm
at the time, so I was about 32. Between my husband and I, in our 401ks, we had about $100,000. It was like maybe $90,000, but that was a decade of work, right? That was a
Okay.
decade of contributions.
All right. Let's take a beat here for a second. So it's important that people hear what you started with. They can't do what you did with 5K, just to be fair, right? So you had altogether, both of you, around 90K. So that was the first investment, basket you had. Okay. And what did you do with this?
Yeah, and actually, I would say it's okay to start with $500. What you want to
Yes.
do is continuously add to it. So it doesn't matter if, obviously, if you are 20, you have a longer time frame. But even if you're 50, what you want to do is start with the amount of money that you can. So I
hmm
would say that it's okay to start with 500 a month or 250 a month
Oh,
or $4,000 a month, right? Start with what you could. Now, it was just at the time because I had been putting money aside into my 401k. Now, the money wasn't really being invested, it was just sitting there because I didn't know I
mhm.
had to choose the investment. But when I sort of realized, okay, I really want to be more intentional about building wealth, we had around 90 to $100,000 between the two of us. And I said, okay, I know that I need to put more money into my workplace retirement account. And there are caps to that, right? You can't put all of the
Mm,
money in the world. There are certain limitations. Even if you are an entrepreneur, there's certain limitations. So what I started working towards was reaching that limitation. So here in 2025, even if you wanted to put more money, if you are a 9 to 5er, the maximum amount of money you can put into a 401k is 23,500. Now that number
mhm.
shifts and change if you are an entrepreneur because not only can you put money as the employee, but you can also put money as the employer.
Employer.
So
Yes.
this is a
Okay.
huge benefit to
Yes. Yes.
entrepreneurs.
Okay. So I agree with you. I'm not saying that we have to have 90K, but I'm saying with your story, we want to just know what the number this is based on. And I agree with you. Of course, we don't want to wait till you have 90K. Start now. Start like I'm actually in the middle of helping my 18-year-old set
Yes.
up. She just started making any amount of money. And I said, we are going to set it up. So I agree. The earlier, the better. Because when you get older, you only have a certain amount of years and the percentages just don't work in your favor the older you get. So I was just being clear on the critical mass you had with what you did, not to say don't do this if you don't have money. Does that make sense? So you had 90K and you put it into, did you put it into the total stock market?
So I left it in my 401k because my employer had something similar to the
Got it.
S&P 500. And so that's why when we're thinking about investing into your 401k plans or workplace retirement accounts, solo 401ks, things like that, you might have access to these already. So I didn't take the money out and invest it
Mm,
somewhere else. I
right.
just chose the
Elected.
investments that aligned with index fund investing, right? Where I didn't have to choose specific stocks. I could
Mm-hmm.
just buy into something called a mutual fund, right? An index
Sure.
fund is a type of mutual funds. And
Mm-hmm.
mutual funds can get a bad rap because some mutual funds have incredibly high fees. And the ones with higher
Mm.
fees tend to have portfolio management or managers assigned to them. So that is
Mhm.
someone choosing what is going to make up that basket of investments. Where in a
Mm.
mutual fund that is specifically an index fund, there's not someone choosing the investments. It's just a list. It's just an
Mm.
algorithm. It's just a computer that does it for you.
Right.
So the first thing I did was take the $90,000. I didn't take it out. I just made
No.
sure that now it was
Yes.
being invested into something like the S&P 500 or the total stock market index fund, right?
Right. Okay. You elected, and I understand you allocated. Okay.
Correct.
And then
Correct.
and then how did you get to a point? I just want to get to you started with that, you elected that, then what happened, and how did you get to, to a point? How long did it take you from that to saying we can quit our jobs? And what were the numbers?
Yeah. So we had about that 90, I can't remember. I think it was like $96,000. So it was between 90 and
Okay.
$100,000 uh, back in 2016. It
Okay.
took us to reach $1 million by 2021.
Okay. So that's amazing. Let's work that out. That's 5 years.
That is
Okay.
5 years.
So you got 96K and you 10x'd your money almost in 5 years. Okay. How did that happen?
The first thing that I did was make the maximum contributions to my workplace retirement account. The second thing that I did was max out the maximum contribution to a Roth IRA. So
Hmm.
today, the maximum contribution to a workplace retirement account is 23,500. At the time, I think it
Hmm.
was about 18,000. It's gone up over the
Mm.
years. And the maximum contribution to something like an IRA, a Roth IRA, a traditional IRA
Hmm.
in 2025 is $7,000. So this number goes up. I think at the time it
Yes.
was 6,000. So one of the
Hmm.
things that my husband and I did was contribute the maximum to those
Mm.
accounts first. So
Hmm.
now we weren't putting in just, $5,000 a year or $10,000 a year. We
Hmm.
worked our way so that we could make sure that we were optimizing and taking full
Hmm.
advantage of that tax benefit by putting in the
Sure.
maximum allowable amount. So we did that
Right.
every single year. Then we also had money set aside from that or not set aside, we had money left over after we
Hmm.
really got crystal clear about what our financial goals were that we could invest above and beyond. So
Mm.
what we did was over those years, now this didn't happen in year one. This really, every year it increased little by little. But
Mhm.
by the end, we were able to invest about $90,000 a year. Now, remember,
Mm.
this is 401ks, IRAs, and then outside of that, we had a regular taxable brokerage account. Now, the
Right.
taxable brokerage account doesn't have the same benefits as a retirement account, but there are some tax benefits there for sure.
Mhm.
But it also offers the most flexibility, right? Because
Mhm.
any money you put inside a taxable brokerage account, you can take out or withdraw at any time without
Right.
sort of jumping through a couple hurdles. And so
Mhm.
we slowly began investing more and more and more. And so I think at maybe it was 1 or 2 years where we actually reached the $90,000 a year. But every
Wow.
year we were investing a little bit more. So it was about 50,000 for each of us. But again, if
Mhm.
your workplace retirement account and your IRA, can accept, right, 30,000, now you just have a few $1,000s more each month where it
Right.
can get. Now, I will also say that during this time, the stock market on average returns between 10 and 12%. But between 2016 and actually even 2025, the average has been higher than 10 to
Which
12%.
is incredible because in the old days, I had a mutual fund and it lost me money. It went down. It was like the year 2000, 2001, and it almost went to nothing, And so you can have spates where it's not just climbing. I was with Vanguard,
Yeah. And I would say here's the thing, right? When we're thinking about, I'm going to take a step back. When we're thinking about saving money, that money really should be there for two reasons. One, an emergency. And
Yes.
I like to call it my do not touch unless you're dying fund. So this is going to cover
Mm.
my mortgage. This is going to cover those unexpected expenses that are going to come up, right? When life happens, right? That is my emergency fund. But and then I also have a savings account, where is my saving to spend fund, right? I save money for a vacation. Then when vacation time comes, I spend it, right? I
Right.
save money for a house renovation. And then when the house, when it's time to do the remodel or the renovation, then I spend it. And I think sometimes people will have one lump sum for savings, and then they feel guilty about touching it because they were like, oh,
Sure.
this money is not meant to be touched. And I like to divide savings into those two things, right? Sort of like, this is my do not touch under any circumstances money, unless if it's an emergency, whatever you define as emergency. And then there's my saving to spend fund. Any money that you know you are going to be using in the next 1, 2 to 3 years really should be in a savings account. That money
Right.
is not meant to build us wealth. That money is
No,
meant to
no,
be
for
used.
sure not. Okay, so let's get back to this. Let's get back to the numbers. So you guys were putting in about 50K each
Mhm,
because you were living, under your means. That's important too.
mhm.
And you're saying that because the stock market did better in those years than normal, that's why you got to 10xing in 5 years,
Oh yeah,
correct?
it increased, I mean, hugely, right? Like the
Right.
stock market was up. Now, I will say that during that time, it wasn't that it was up every single year, because it
No, but
wasn't.
generally.
Right.
Yeah.
When we take the average of those years, right?
Yes.
Because even
Yes.
in the last, since we uh, quit our 9 to 5s, our portfolio continues to grow, right? When we're
Mm.
thinking about just year to date, right? We're here
Mhm.
sitting in September 2025. The stock market is already up 11 or 12%. And so if
Mm.
you had $1,000 invested in the S&P 500 or the total stock market,
Mhm.
you would be up 12%. Imagine having $100,000 up 12%, or
Mm.
$1,000,000 up
Right.
12%.
Okay. So let's get back to the numbers. So you
Yeah.
got to 1,000,000. All
Yeah.
right. And then what did you guys do? When did you get to the point where you said we can quit our jobs? Because I didn't realize that these index funds, you're getting a dividend paid to you that you're paying for your living every year, every month. Is that what happens?
No, so we just reinvested the dividends until we were
Uh-huh.
ready to leave our job. So we reached the million in
Yes.
2021. Then the stock market went down, so we went down to like
Of
800,000,
course.
and then it's
Yes.
just continued to go up. So in 2023, we had realized that we had enough money in our nest egg that we could
Mhm.
withdraw from our nest egg about
Mhm.
4% every year. And this
Ah.
is where the 4% rule comes in, which is a number that financial planners use to sort of understand, when do I
Mhm.
know that I have enough. And the way
Mhm.
you want to figure this out is by taking what your annual living expenses is. So not your income, but your actual living expenses. And I'm not talking about just the essentials, like the roof over your head, food on the table. Of course, we want to
Everything.
include that. We want to include your entire lifestyle, because we want you to live in that same way without feeling like you're, sort of like being frugal, right?
Scrimping. Yes.
Right. You want to make sure you're living life.
So we're yes. So let's just clarify. That's rent, that's food, that's transport, that's vacations, that's buying clothes, that's doing stuff, that's buying people's gifts, that's going to dinner,
Yes.
that's insurances,
Correct.
everything. So you get that number, and when you know that the 4% will cover that, then you can stop working.
Yes. What you want to do is take your annual expenses and multiply it by 25. Okay. So let's say,
Mm,
for example, your annual expenses are $80,000 a year, then you would need 2 million, right? If your annual
mm,
expenses are $40,000 a year, then you would need 1 million, right? So
mhm,
really sort of understanding what your true annual expenses are that would
mhm,
cover your lifestyle. And once you've
mhm,
reached that number, so if we sort of do the math backwards, right?
mhm,
4% of 2 million is 80,000. And so
mm,
you can withdraw 4% out of your portfolio every single year. And that money is continuously
mm,
growing, because it's not like when you reach financial independence, you stop investing. You
mm,
continue to invest that money. And the stock
mhm,
market on average grows 10% every year. So imagine this, your portfolio is growing 10% every year, but you are only living off of 4% of it. And
Mm.
that is financial independence at its core, right? So, and it can feel really overwhelming to think about, oh my gosh, I have to build a $4 million portfolio. I have to build a $2 million portfolio,
Mm.
right? It
Mm.
can feel really overwhelming, but I always like to share the numbers of how long it took us to build $1 million portfolio, because the stock market is doing its work as long as you continuously and consistently put money inside of the stock
Okay.
market.
So there's the thing that people might not get. Let's say you have 2 million and you say, 4%, was it 100 and what was it? 180,000 for 4% of 2 million? What did you
Yes,
work out?
it's so 4% of 2 million is 80,000.
80K. Okay. So you need 4 million, or was it? Yeah, no, 2 million. And when you reach 2 million, you're like, hey, would 80K cover everything for the year? Probably
Correct.
not, but let's just say you live in
Mhm,
Ohio or, whatever. Okay.
mhm.
So you're taking out the 4%. Okay. So if you're not working anymore, you're not putting any more in,
Correct.
because so it's
That's
still,
it.
because it's still you're still getting 6% because you only took 4 out. I get it.
Exactly.
So then that, but there seems to be like there might be a point of diminishing returns if you don't put fresh money in, though.
No, the money continuously to compound. This is the
Okay,
beauty
so
of the
then you're
stock
still good.
market. You're still
Okay.
good. We left our positions, we left our jobs and have more money in the stock market, even though we have not added a single dollar. But the stock market
Mm,
has added more money, right? So our
mm,
portfolio has grown by several hundred thousands of dollars every year,
mm.
not because we're putting more money in, but because the stock market continues
You
to
just
grow and we are not pulling out.
you're not pulling out, but you also have businesses because you're a coach. So you haven't actually stopped working.
So here's the difference, right?
Mm,
What I use my financial coaching business for is all of those. It's that extra cream on top, right?
mm,
So I pay all of my vacations, things like that, through my regular portfolio withdrawal. But any money
mm.
that I make from my business is my opportunity to give above and beyond. It's to be able to say,
Yes,
okay, instead of staying at a four-star hotel, we're going to stay at a five-star hotel, right?
got it.
My portfolio covers a four-star hotel because that's how I used to travel before, right? Instead
Mhm.
of maybe traveling first economic or economy class, we're like, you
Yes.
know what? With the business, I'm going to go first class.
Right, right. So it's adding value to your life, and it's not about, because I have a problem with financial gurus who are always telling people to be frugal. We're here to enjoy
Oh
ourselves
yeah,
too. And if it's all about just saving money, what are we saving it for, actually?
that's
Because,
exactly right.
right? I mean, I love that you said just the fun money. Well, this has been a really great explanation. And I thank you for coming on, explaining all the numbers. 'Cause I think the numbers and what things mean are really important for people that are a little confused about how the numbers work. So that was great. So, Wally, before we close off, why don't you leave the listeners with a philosophy or a mindset that you live by?
Yeah, I would say mindset is the biggest thing. I think knowing that financial independence is available to you with a plan is sort of like the first thing. Just begin, like, I know you may not be able to see it right now, but just know that it is available to you with a plan. Really get super intentional about how your money is coming in, understand what your revenue is, understand what your income is, and then understand truly what your expenses are. When we're thinking about building wealth, it's just the leftover of your income minus your expenses. Whatever's left over is what you're using to save and invest and to build wealth.
Mm,
And so if you are, bringing in $10,000 a month and $10,000 a month is going out the door, it doesn't really leave room in order for you to build wealth.
mhm,
And I
right,
100% agree with you. It's not about frugaling your way there. Frugality is a way. For some people, that is totally fine. But for most of us, we want to be able to enjoy the journey, not just wait 10 years or 20 years from now to
right.
enjoy it. We want to make sure to enjoy the journey. So when we're thinking about, okay, I know what my income is, I truly know what my expenses are, right? And take a look at what those expenses are. Make sure you're spending money in the things that really add value to your life, right? There's so many
Mm,
times we have sort of these wallet leaks. There's like
mhm.
money sort of spilling out. So understand your income minus your expenses, and whatever's left over is what you can use to build wealth. And you can either increase your income or you could decrease your expenses or do a mixture of both.
Which is probably the best. Well, thank you again, Walli. Thank you for listening. I hope you got a lot out of this. And we look forward to having you on the next show. If you like what you're hearing, subscribe and even write a review. And we will see you on the next show. You're listening to the Business Wealth Impact Podcast, your source for empowering information and cutting-edge ideas from the world's top minds. I'm your host, Jean Amlour, founder of seven-figure coaching company, Jean Amlour International. Join me on a journey to unleash your potential and create your highest success. Welcome to Business Wealth Impact.